backdrop currently, and Luke's going to give kind of an overview of what a recession means in historical context. I'm going to go over kind of secular trends that kind of color the broad market. Remember, the economic cycle is just that. It's a shorter term cycle. Although it seems long, right? It can take a decade or so for you to go through an economic cycle. There are longer term cycles that we call secular trends. So we're going to look at that, and then how to adjust your investment strategy accordingly. So we'll start off here with the economic backdrop. And as I said, the fiscal dominance is really the name of the game here, and why we didn't go into recession this year. We had an 8.7% increase in Social Security, COLA increase. You had tax brackets also adjust as well. So basically, you could earn the same amount going into this year, but because tax brackets were adjusted higher, you actually got a raise. And so many people were getting either raises from their company or the government, and they were taxed actually less in many instances. And so that, along with saving or income actually coming from your savings, once again, we were so used to 0% returns on our savings accounts and financial repression, and now we are getting something on our cash, right? 5.5%. And that is another level of income that's coming really directly from the government. That's another form of fiscal spending. When debt pile is so large, it's owned mainly by those within the country, whether that's a individual or a corporation or an investment fund. That money is effectively going into the economy, and all of that is considered stimulus in some way, shape, or form. And so this fiscal dominance that is likely to not just be this year, but it's going to persist, and it's going to kind of ebb and flow, but that is part of kind of the secular trends, which we're going to talk about. On top of that, there's a lot of new housing demand and a lot of manufacturing capex. So this is driving construction employment, and construction employment is typically a leading, which we're going to talk about in a little bit, a leading indicator to a recession. But so far it's been resilient. Why? Because we know existing home supply is limited. That means that the marginal supply within the housing market continues to come from new homes. New home builders are doing well. They're buying down rates and offering mortgage rates in the 5s and the 6s when everyone else who wants to buy an existing home is in the 7s, right? So the demand for new homes continues to be strong. And that is why the consumer remains resilient. Unemployment rate still below 4%. And while manufacturing is mixed, it had been weak, right? Everyone was buying too many physical things in 2020 and 2021. 2022 was a year where there was kind of that give back, where people stopped buying those things. They started spending more on the service side of the economy, and that's starting to come back the other way again. So you're seeing a bit of a manufacturing rebound as well. The employment market, it has weakened a little bit. We've talked about, I think we bottomed at 3.4% on the unemployment rate. Now we're at 3.9%. And historically, people will say if unemployment rate rises 0.5% from its low, that will signal a recession. I don't know if I really buy that. I think that's too kind of simplistic, but that is kind of one check mark. Remember, these are multiple factors that can build over time that could create a recession, and which we'll get to. COLA adjustment for next year is going to be much lower. I believe it's 3.8%. So that's still higher than historical averages, but obviously not 8.7. And so, but remember, this builds on itself, right? That's 3.8 on the increase of 8.7 this year. And so I think with the fiscal dominance backdrop, what you have to recognize is that a major deflationary recession like 08 is unlikely, okay, because of that fiscal dominance. Now, consumer sentiment, that has fallen back from the COVID highs. But what you can see is that you typically need the the consumer sentiment to drop somewhere in the 80s to signal that recession or to signal you're in a recession. So at 103, it's fine. The employment situation, top left is the jobless claims. It's kind of skewed because of the COVID recession, but basically 210,000 is very low. And on the bottom left, you are actually seeing positive. It's kind of faint. You can see in the background. That's actually average hourly earnings minus inflation. So the dark blue line, that is the average hourly earnings that peaked out right around 7% year-over-year growth nominally. But at that point, it was actually negative because inflation was higher than that. Now you've seen both inflation ebb dramatically from 8-ish% all the way down to the mid threes, and average hourly earnings are still kind of around the 4% range. So a little higher than that, 4.5%. And so you're getting a positive, call it 1% real wage growth year over year, which is once again a good thing for the economy. You can see those if you ever see these gray lines on any of these charts, that basically delineates a recession. So know that. So you're saying, what is that vertical line? That's delineated a recession. So you can see the kind of environment that a recession creates, and that typically is negative real income growth. So right now, you don't really have that. And then the misery index, while everyone talks about how bad the economy is, right, the sentiment around the economy, polls, et cetera, is that the economy is bad. And a lot of that is around inflation, but inflation is only one part of it. It's all about real incomes, and the misery index is really what kind of helps show how bad the economy is. And that takes the unemployment rate plus inflation. So if you're getting high unemployment plus inflation, that creates a stagflationary environment. That's not good for anybody. Obviously, you had that in spades in the 70s, and you saw that misery index rise over 20%. Now we're at 7.5, which historically is about average. Not high, not low. It's probably, if you get rid of those anomalies of the 70s, it's about average. Okay. Demand in the economy, ISM report, and this is manufacturing and non-manufacturing. Okay. And the light blue is the non-manufacturing. That is the majority of the economy. I talked earlier about manufacturing rebounding, and it is. It's ticked up from the ISM around the 46 range, now the 49. Anything above 50 is growth. So you're getting back to kind of neutral in the manufacturing side of the economy, and the services side continues to grow, although modestly and much lower than we saw in 2021 and 2022. And then industrial production, that's about flat as well, and that is typically a key driver to earnings per share in the markets. And what you see right now, right, we're kind of oscillating around the flat line year over year in earnings growth. So that's to be expected. Now CPI, here is the inflation data, and what you can see on the right actually is the PPI, Producers Price Index, and that eventually feeds into CPI. And what you can see is that this typically leads. So the peak in the PPI was in April of 2022. The peak in the CPI was in July of 2022. So it typically is about a 3-month lag. And what you can see too is you are getting a flattening out of the PPI right around the 2% range. And that's what you're likely to see here with CPI. Probably not accelerating much, but considering consistently decelerating modestly. And that's likely what you should expect for inflation going into next year. The MOVE index, this is more of a measure of stress within the treasury market. I think there was very interesting, just to kind of, we're pivoting a little bit here, but obviously with fiscal dominance and so much debt, there's about dysfunction in the treasury market. And if that continues, then there is either two things happen. The Fed will have to pivot more significantly, or interest rates are going to really take off. And you saw that back in March. That's where this last peak was. And that was during the banking crisis. Anything above 150 is basically saying, hey, the treasury market is dysfunctional. And today, I don't know if you noticed, there was a 30-year auction and it was much higher, about 4.8%, and that kind of created the sell-off in the market kind of later in the day. The Treasury spreads in general are reversing, and typically that creates some that is signaling either two things: a recession, or the market's kind of giving up on signaling on expecting a recession, and that's kind of what you've seen recently. I'll move over to I'll go to that a little bit later. But what this is showing, it is signaling a recession into the future, but that has started to, the yield curve has started to flatten out. And I'll talk a little bit later about that trend towards what is called a bear steepener, and that is going to basically tighten financial conditions in the market, and you've seen that as of late. And then this is the money supply on the right is the big one. It was pretty obvious to us that inflation was going to pick up in last year, because there's typically about 18-month lag between the rise in the M2, which is just broad money in the economy, and inflation. It takes a while to feed through. And you're also seeing that with inflation ebbing as well. So M2 is the light blue line. That one, excuse me, that's the year over year of M2. And what you can see is that's crashed from a high of growth of about 27% year over year in late or early 2021, and now that's actually negative. So that's why you will likely continue to see that inflation line ebb a little bit more. But for now, we'll pivot over to Luke, and he's going to talk about if we are going into a recession, what previous recessions look like, and really what constitutes a recession, because a lot of people throw that word around, Luke, but obviously that is, recessions are rare. So you can talk about it all you want, but they're kind of hard to come by, right?
Yeah, you're correct. There's been a lot of discussion from us and from many people in the media and in finance for some time about a recession, but I think it's important, as the next slide shows, to kind of identify what it really means when people say recession. So first and foremost, a recession has a significant decline in economic activity broadly across the economy. And how that's typically measured is real GDP being nominal GDP, then accounting for inflation. And it's also important to note that recessions are a natural part of the business cycle. So within the business cycle, you have expansion, you have contraction, and every now and then the economy gets a little overheated. Maybe consumers don't have as much money to spend, maybe the supply of goods is too much, but either way, economies tend to, over time, contract on a cyclical basis. From a technical definition, a recession is 2 consecutive periods of negative real GDP growth. Now, just because there's 2 consecutive periods of real negative GDP growth doesn't mean you are in a recession. There's a lot of things that people look at. Justin touched on some of them. One is employment, income production, all sorts of factors. So, for example, a negative 10 basis point real GDP growth for 2 quarters, but you have full employment, something that we saw in the past year or so, does not constitute a recession. And that's just because ultimately the factors of declaring what a recession is are up to the National Bureau of Economic Research. So the only definition that really matters is what that council of economists and researchers decide is a recession. So now let's take a look back through various time periods and kind of understand where we've been before we can talk about where we're going. So, these aren't all the recessions within each of these time periods, but we decided to pick some that are more infamous and some that had kind of commonalities here. So if you take a look at the Great Depression, which is the one on the far right, now you'll see going from top to bottom, the first box in each column is the duration of the recession, what caused it, what the effects were, what unemployment looked like, and then eventually what the recovery was. So in the Great Depression, we had unemployment peaking at nearly 25%. So that's not something that's common amongst all recessions. That was because of really what was going on in that recession, specifically with bank failures and monetary contraction. Now, eventually, even with something that drastic, through fiscal social programs and war spending, we were able to dig ourselves out. Now, within this time period, this pre-World War II, 20th century time period, one commonality amongst all these things were bank runs and high unemployment. And because of that, in the 1930s, Congress passed an act to create the FDIC, which insures bank deposits. And so that would give peace of mind to people that would park their money at banks, that they didn't have to be the first in line in the morning to withdraw it. The government insures up to $250,000 per bank account per person. Now, in the more recent past, after the collapse of some regional banks, we saw the FDIC step in and actually expand that $250,000 and cover more. But regardless, with each crisis, we learn lessons, and there are systems put in place to better prevent a similar crisis moving forward. Now, in the post-war era, which is the next slide, and kind of going through the Cold War into the fall of the wall, if you can move to the next slide. Great. One of the ones that I wanted to highlight was really within that 1970 and 1980 period, because that's more in common with what is going on today, specifically coming out of a period of high inflation. So unemployment, as you can see, didn't reach levels anywhere near what it did in the Great Depression. But uncontrollable inflation coupled with an energy price crisis in the 1970s led to cost push issues for consumers. And after the most aggressive monetary policy that we saw, where the prime rate actually hit 21%. So when people talk about where interest rates are now, it's nothing compared to what it was in the 70s. It reached 21% in 1981. And due to that and defense spending buildup in the Cold War, we were able to dig ourselves out of those recessions. Again, the commonality here is that this is a cyclical thing. Recessions happen. They're not always as bad as the Great Depression or as bad as the recession in 2008, but eventually things do pass. So moving on to a more recent era, we have the dot-com bubble in 2008, the Great Recession or Great Financial Crisis, the dot-com bubble in 2001, the Great Recession or Great Financial Crisis in 2008, and then the quick COVID collapse, if you will, in 2020. So the Great Financial Crisis was caused mostly by toxic mortgage assets that were collateralized and kind of prevalent amongst company balance sheets, because companies would use what were seen as safe investments as collateral to take on additional loans. When those assets were determined to be toxic, the collateral that was used for those loans was essentially worthless. And so companies would have to come up with new collateral that they couldn't, and there were a lot of companies that folded. So really, without the widespread bailouts and direct injections of capital kind of unseen before this crisis, it's uncertain if the global financial system would have really recovered. In 2008, many people were forced to sell their homes. Many people were underwater on mortgages. And that's something that I think a lot of people, and Justin would agree with me here, have some stress about, because it's really the most recent economic downturn of significance that most people have lived through. Unemployment peaking at almost 25%. But again, one of the tools, or really two of the tools, fiscal and monetary policy, have always been used by governments to help dig us out. So that was also something that was used in 2020, when that was more of a kind of a sickness, illness, pandemic related shutdown where business essentially ceased, right? I apologize. That's where unemployment peaked at 15%, because business essentially ceased. But without the help of governments kind of keeping people afloat, we wouldn't have really been able to have that be the short-lived crisis that it was. So what can we really learn about all of these things? There are some commonalities, common factors amongst all of these recessions. One of them tends to be high inflation, so rapidly rising prices eroding purchasing power. There's an old adage within the industry that unemployment hurts few people and inflation hurts everybody. So, when there's 10% unemployment, not everybody is feeling the pain of the recession. But when there's 10% inflation, everybody's feeling that pain, because energy is more expensive, gas is more expensive, groceries are more expensive. So it really hurts consumers broadly. Another thing is excessive.
And that goes back to negative real income growth, right? So if you have high inflation, you're more likely to have that negative real income growth that crimps economic activity because people's pocketbooks are tighter.
Exactly. Another one is excessive debt. So Justin and Steve and I talk all the time about making sure that the companies you're investing in aren't too highly leveraged. And why is that? Well, because the business cycle is cyclical, as the name implies. Profits are also cyclical as well. So companies that are highly leveraged and take on a lot of debt in times of economic stress can't really service that debt or roll that debt. That was a big problem in 2008, where a lot of the assets that people thought were worth something on their balance sheets were worthless. So that can really exacerbate the effects of recessions. Another important one is external shocks. So that would be like the price oil shock in 1970. That could be the COVID pandemic in 2020. So there are these exogenous events that are outside of the market that can lead to real long-lasting or short-term depressions in economic activity. There is, however, as you see in the next slide, kind of a typical path for digging ourselves out of these recessions. One, as I mentioned before, monetary stimulus. Central banks can come in and lower interest rates and implement quantitative easing to kind of make it easier for borrowing and investment. Fiscal stimulus, like in 2020, when they literally put checks in people's pockets to keep them afloat so they could continue paying their bills. Really, if you think about it, having eviction moratoriums is also kind of a form of fiscal stimulus, right? Essentially, what you're trying to do is you're trying to make it so consumers can continue to live the way they live and spend money in the economy. If they're not getting kicked out of their house, they can use that money to help stimulate the economy, go out and purchase things. That's something that was really important in 2020. And over time, consumers start to regain confidence as things ease up, which means they're going to be willing to spend more money and stimulate the economy as well. And really, private sector innovation as well. I think one of the things that you've seen, or hopefully we can see going forward, is that costs of these companies, even highly leveraged ones with artificial intelligence or technology, goes down, meaning they're less likely to be punished for having more debt. They're less likely to have to take haircuts on those bonds if they fail. And it's just overall going to help spur and rejuvenate economic activity.
Yeah, productivity gains in general are just great for the economy, and you can dig yourself out of major holes with great productivity gains. And that's a potential going forward if you get say you get a breakthrough in fission energy, for example, and you find some way to produce clean energy that is non-toxic to the environment and super cheap, and that can create a massive boom in economic growth and productivity, and dig ourselves out of potential debt problems. So and that can happen that's from a large scale perspective, but also from an individual company, right? If a company maybe is on hard times, but then it creates some breakthrough innovation that can spur it out of its doldrums and into rejuvenation. So new technologies and productivity gains, both on a large level and on a micro level, are very important. So that Luke gave you kind of an overview of the history of cyclical in the economic cycle and recessions. But I'm going to talk a little bit about the secular trends that are starting to emerge. And we just got done with a period of disinflation. And we're entering into a period of inflation. And I want to talk about why that is. And that colors what the next environment or next recessionary environment will look like, and the investment landscape, both whether you're in a recession or not. Now, the first thing to recognize is that basically starting in the late 70s, when Japan was building Hondas and Toyotas and just basically out innovating our domestic car makers, and they were gaining major market share. And back then, everyone was talking about how Japan was going to take over the world, similar to the way people were talking about China over the past decade or so. And Japan at that time had very good demographics and a lot of young people and highly educated, and they were the ones that were producing good quality products at cheap prices. And then you had the fall of the Soviet Union in the early 90s, and that opened up the access to cheap commodities, and you had a peace dividend. And what that did is allowed the free flow of goods around the world. And it was a combination of Western capital and Eastern resources. So talking about Japan, Soviet Union, and China, and that's what this is all about. And that's what created disinflation. China obviously joined the World Trade Organization in the late 90s, and that opened up access to cheap labor. So you have a combination here of cheap labor, cheap commodities and energy inputs into an environment where you were getting capital from the West, right? Companies that were investing there and being able to drive this disinflationary environment that's basically lasted up until COVID. You're starting to see some of these signs emerge pre-COVID. For example, the wage inflation in China was ramping up well before COVID. But obviously this is all really reversing in this new multipolar world. Now Japan, which did have good demographics, has terrible demographics. Why? Because when people work in factories, they're getting wealthy. Their children become more of a, or potential children become more of a burden than help, right? Because usually in the 100 plus years ago, you had children to work on the farm and take care of you in your old age. But if you have social welfare programs and you don't have a farm, you work in a corporation, you don't have a lot of reasons to have children, and that's what happened in Japan. China is obviously the one child policy has created their demographic situation that's even worse than Japan. Japan's been in a bad demographic situation for a couple of decades now. China is just entering the start of that, and they're in an over-indebted economy, over-investing in real estate, and obviously there's too many apartments and properties in China. And so they've misallocated their capital in a major way, and that's why they are suffering kind of the consequences. And then you have Russia, obviously regional war. They also have bad demographics, and their resources, energy and commodity resources, are now being they're not off the world markets, but certainly their ability to maintain that is going to be hampered by lack of access to that Western capital, that Western know-how. A big reason why their energy assets or energy exports have boomed is because they brought in the Halliburtons of the world and the Schlumbergers of the world to actually service their wells and be able to pull these energy assets out of the ground in very harsh conditions. And so without that, I think over time that's going to they're going to struggle with that. And that's this is all why populism is really rising around the world. It's not just a U.S. centric thing. You have Brexit in the U.K. And many politicians that are gaining popularity. France, for example, that are more populist and less about free trade, right? More protectionist. And then you're starting to see that flow into policy. So the industrial policy here in the United States, the CHIPS Act and Inflation Reduction Act is kind of the first step in the in major industrial policy in this country in many decades. And you're also seeing the retrenchment military-wise with what's happening in Russia and in Israel right now. Is we're helping with obviously money and military intelligence and weapons, but there's not a lot of support for boots on the ground, and so our military involvement around the world is becoming less impactful, and therefore it's not as easy to move goods safely around the world. And you're starting to see that impact from the CHIPS Act really at play here. Here's the construction spending, total construction spending here in the United States, obviously at record highs. And I like these charts the best because what it shows you is based on what sector. And you can see the dark blue line, that is computer, electronic, and electrical. And that is because of obviously reshoring and manufacturing, but incentives. And we've only really done industrial policy in that part of the economy. So we really haven't put industrial policy quite yet. So I think there's still more room to run. Obviously, the lobbyists in the chip industry, in the computer industry, and the clean energy industry are very robust. And I think it's just a matter of time and maybe a recession that will spur a similar chips type act for the chemical industry, right? So we're not as dependent on China for the for certain minerals and chemicals that they're producing in a environmentally unfriendly way, for example. So there's a lot of room to go here. Okay, and then you can see that on the right side too, which is real manufacturing construction spending. You can see the growth this year compared to basically the last 17 years on average in the computer and electronic. Transportation's got a bit of a boost, chemical as well, but there's still a lot of room to run. And then this is, I think, the biggest issue going forward is the structural deficits. And you can see on the left is the purple on the bottom is the surplus as a percentage of GDP. Right now we're at negative 5.3%. And with unemployment rate at 3.8, 3.9%. So we've never had a deficit this large with such a low unemployment rate. You can see is when unemployment rate rises, the deficit gets worse. That's just natural, right? Less people paying payroll tax and income tax, et cetera. More people on the government dime from unemployment. And obviously the government typically stimulates in that environment in some way fiscally. But they don't really need to do that as much anymore because a lot of it is built in. Okay, and you can see in this on the right is the forecast going forward of the deficit. It's not going to get better. Okay, and this is in the best case scenario. Basically, for the next decade, the deficit is flat, but that's without a recession expected. We know there will be one at some point over the next decade. And this is a great visualization of why the government has to do two things. They have to do either entitlement reform or they have to monetize the debt. And the question to everyone out there is, how many politicians have you heard on the left or the right or the center that want to touch entitlements, that have said, yeah, you know what, Social Security, we need to change that? I would say the only thing that they've done is the Medicare prescription drug negotiations. Biden is now at 10 drugs that they're negotiating on, and that's going to increase over time. So I think there could be some minor cuts there, but that's just on certain drugs. You're not talking about all the other aspects of healthcare spending that our government has to spend for Medicare, Medicaid, et cetera. And you see on the left here is total revenue last year, 4.9 trillion. Mandatory, so that includes Social Security, Medicaid, Medicare, et cetera. That's 4.1. And net interest last year was $500 billion. This year, with rates rising and us refinancing those expired or maturing Treasury securities, it's about $1 trillion. So you're basically saying mandatory plus interest is equal to our total revenue. So you could just cut discretionary as much as you want. You're going to have a deficit compared to your revenues. So you have to cut entitlements or you have to monetize the debt, which I expect them to continue to monetize the debt over time. Right now they're not, they're doing QT, but QE or yield curve control or some type of debt monetization is likely in the future. And then growth going forward. 79% of projected spending increases will come from those mandatory parts of the budget. And then obviously interest as well. And here's the great chart from Double Line, obviously a big bond management company, and the interest expense in different scenarios. So look at the yellow line, which is 6% interest rates. We're basically there now, right? We're at 10 years, right around 5, a little lower than 5. So that's roughly where you're at. And it just shows you by 2030, the interest expense, the percentage of tax revenue is going to rise to over half. You know, almost any scenario that's not, you know, sub 3% interest rate. So basically, that's where the Fed needs to keep the cost of borrowing around the 3% rate or lower. And I think they eventually have to get there. And so what I want to hit on is the lessons from the past of how governments are going to deal with this. And Luke talked about the history of you know, the recessions in the early 1900s and how that shaped the FDIC, but it also shaped the New Deal. And while everyone has PTSD from 08, that's what most investors talk about, everyone's worried about a deflationary bust, that's what 08 was, politicians had the same PTSD. And so in the 1930s, it was all about the Great Depression and avoiding that again. So it was about increasing the social safety net, Social Security, for example, creating FDIC. That was shaped by their PTSD of the Great Crash and the Great Depression. Recently, the Fed, since 08, has met every deflationary event any major decline in equity prices or blowout in credit spreads with some sort of stimulus. And that was consistently doing QE throughout the 2010s. And then during COVID, they ended up buying corporate bonds, for example. And then more recently, with the banking crisis, what did they do? They created the new credit line to basically take these underwater assets off of bank balance sheets and replace them with cash at par. And it's pretty clear that this is the trend. This is what they're going to do. They're going to kind of paper over each problem, each deflationary impulse with some sort of facility, stimulus, etc. And in the private sector, this happens as well. So home builders, one of the reasons why we have a housing supply shortage right now is because they overcompensated. They built a lot less homes than they really could have sold because they didn't want to get into a situation like 08. Lenders did the same thing, right? They started. If you have a mortgage, have you received a mortgage over the last decade, you know you have to jump through a million hoops. It's no longer just sign a dotted line and you can fog a mirror and you can get a loan. It's not a thing anymore. So they overcompensate the other way. They only lend to the strongest borrowers. They make sure that every I is dotted and T is crossed, and that means it's hard to get a loan, and that means that there's unlikely to be, a major default cycle, okay, like 08. Okay, so in the end, inflation is more politically expedient. It's easier to deal with what we kind of dealt with lately over the past 18 months than an 08 financial crisis, right? Obviously, the powers that be went overboard with stimulus, both on the fiscal and monetary side in 2020 and 2021. So it's likely to be, hey, not 8% employment, but 4% employment, or it's not employment. 8% inflation is probably going to be more like 4% inflation, which is like a frog in a boiling pot. You don't really feel it nearly as much. Okay. Now they're doing a few things to allow this inflation. One is Treasury is issuing shorter maturities. We saw that recently with the refunding announcement. They're going to focus on the kind of the belly of the curve, 3, 5, 7 years, as opposed to those 10, 20, and 30-year bonds. And debt monetization in this environment where you have high debt to GP ratio has happened before. It's happened in the actually 40s, post World War II, in World War II and after. The Fed basically capped T-bill rates. I think it was at around 2%. And what did that do? People sold off their T-bills because their real returns were negative, and more was held by the Federal Reserve. Now, here's the bear steepener that I want to get to earlier. And this basically shows that going into recession, the long rates tend to rise. And that usually tends to break things. So that's the purple line. And the orange line on the bottom is the spread. So when this goes up, that means the spread is shrinking. Okay. Sorry, it's widening. I'm sorry, spread is widening. And so typically as you go into recession, the short-term rates stay flat, 10-year rates rise, and that breaks things. And then you go into what's called a bull steepener, which is the opposite, where longer rates go down, but short-term rates go down even more. And this is 3 instances where this basically happened. And then this is the current environment where you see the purple line, that is the 3-month. So you've seen the Fed kind of pause, and the market's been priced in this Fed rate for a while now, really since the springtime. But the long end of the curve went up. And that, once again, typically does break things. So this certainly is an indicator that a recession is on the horizon. Another is cyclical employment. So the jobs numbers, everyone talks about the jobs numbers, and I think those are important. But it's really about what sectors are actually creating jobs and which ones aren't. And the cyclical parts of the economy are certainly struggling. Because if you look at what's still rising, this goes all back to 2003, what's still rising are the red and the green at the top. And that would be government in the red, And the top green would be the private sector, private education and health services. Non-cyclical, right? Health services are non-cyclical. Now, what has flattened out and rolled over? Professional and business services, that's the yellow line. The retail trade is basically flat. Retail trade has rolled over slightly. This is coming straight from the Bureau of Labor Statistics, so their charts are not wonderful. But I did want to point out, manufacturing, that has rolled over a bit. And then same with transportation and warehousing, that is now on decline as well. The one that has held up well is construction. And so we talked before about how construction typically leads. That is, I think, the savior of the economy right now is the housing market and the actually lack of supply in the existing home market. So paradoxically, whoever says housing is bad, new home market is actually pretty good. And that's what's actually keeping the economy up, which typically is the opposite. Typically, housing is leading you into recession. And that's not really happening quite yet. But I am watching for a potential rollover in that part of the economy. So when a recession hit, typically you start to feel a tightening cycle about 16 to 18 months after it starts. And we're in that time zone right now. Okay, so remember, I talked about how M2 growth typically will peak 18 months before inflation peaks. Well, same thing with the tightening cycle. There is a lag effect. And recessions on average are on average 22 months after the yield curve inverted. So that puts you in a recession early next year. But the true impact of when the tightening cycle hurts is when people have or companies have to refinance. I talked a couple days ago about how a lot of companies have locked in low rates for many years, and even on the junk bond market, the ramp up in refinancing doesn't happen actually until 2025, and really in earnest in 2026 and 2027. So I think that part of the pain hasn't quite been felt by large corporations, which are the employers that will eventually have to lay off workers if they feel those financing costs rise dramatically. Now, when a recession hit will also depend on the easing of financial conditions. So the reaction from the Fed last week was that interest rates went down, the dollar went down as well. How much staying power does that have? You saw that today with interest rates going up because of the bad Fed auction. That obviously is going to be negative. And so once again, I'm watching for construction employment weakening. Will you have a debt showdown in Congress? That could be an issue, as well as the base effects. So Q3 is probably the time where I say you're going to have a recession, mainly because remember we had that 4.9% GDP growth in the third quarter. Well, now when we get into the third quarter of next year, it's going to be looking back at that third quarter. Remember, these are year over year figures. So the base effects are important as well. And then will there be a credit event? Will there be another banking crisis like we saw in March, but maybe in different parts of the economy? Maybe it is in the commercial real estate space. I think that's something that will be on watch. So I'm in the mind, Luke, that recession will probably hit second or third quarter of next year, but probably more like the third quarter. What are your thoughts?
Yeah, I think that's about right. But really the important part is how should you be investing your money, right? So moving on to the next slide, you can kind of see a lot of people want to take their money and they want to run and they want to put it under the mattress. And should you put it under the mattress? And the answer is no. There's still opportunities to invest your money to maintain your capital, but also grow that capital. And one of the most important things is diversification. And I don't mean invest in energy stocks and tech stocks and also invest in financials. What I mean by diversification is against asset classes, because different asset classes can have different correlations. Another one is defensive stocks. Focus on those companies that are in businesses that aren't going to be hit as much in a recession. That's going to protect the capital that you already have. Another thing you're going to do is shift towards high quality bonds, right? So companies that have lower credit quality are going to be more likely to face bankruptcy or face financial stress because their profits are going down or they have to roll at higher interest rates. So because of that, it's now more important than it ever really is to make sure that the balance sheets of the companies you are investing in are strong. And lastly, you need to maintain a level of liquidity, right? So in times of economic stress, less liquid investments, real estate, as an example, if you need the money, they're difficult to get out of, or you have to take a haircut. So really focusing on those things is really important. So now we're going to take a look at how different asset classes are affected in recessions and kind of how you can mix them to have the best portfolio for what is coming. And the first we're going to touch on is equities. And equities, stocks, as you know, represent ownership in a company and an interest in the assets and profits of that company after debts are paid. So what does that mean? That means that if a company does go bankrupt, they got to pay their bondholders first, and anything that's left over is given to the shareholders. Now, because of that, they tend to be affected more dramatically in economic downturns because they're directly tied to company profits after paying all of those expenses. And we always preach, like I say, like Justin says, looking for stocks that offer good value, that don't trade at outrageously high multiples relative to what they own and the money they make. We also stress investing in companies that generally have lower debt levels for the reasons that I mentioned. And really an example of that is looking at these two charts. Now the top chart is showing you the 12-month speculative grade default rate. So that's saying that essentially in times of economic stress, what you're going to see is you're going to see more company defaults. So that really emphasizes the point of why it's important to maintain your allocation towards companies that have strong balance sheets, that have low debt, that have low leverage. And that's, again, because that bottom chart, you see that during those recessionary periods, which are shaded, corporate profits tend to go down, which means they have less money to pay those debts, which also consequently means they have less money to pay you, the shareholder. And like I mentioned before, not all businesses across all sectors perform the same. So this next slide is a perfect example of this. And on the chart on the left, you see the average period returns going back to 1960. And so you'll see that the bottom four sectors, consumer staples, utilities, healthcare, and even energy, don't underperform as much as the other sectors. And why is that? It's because those are in businesses where people don't necessarily cut back, right? People are going to cut back on spending, but not really within those specific sectors. And because of that, their profits aren't going to suffer as much. And this chart on the right is really just showing how different sectors are performing going into, while in a recession, and coming out of a recession, kind of each dot representing something different. The black dot representing average excess monthly returns during the entire period, the purple dot 3 months, the first 3 months of the recession, and the green dot the first 3 months coming out of the recession. This really hints at the importance of always being diversified, because you don't really know when a recession is going to come, and you don't really know when a recession is going to end. So keeping focused and maintaining and realizing where there are buying opportunities going in, and once those things have bottomed out, where there are buying opportunities coming out, are critical to having a smoother investment experience. Another stable asset class for most investors is fixed income. So fixed income tends to experience recessions differently. And there are opportunities leading into fixed income and how you should change your portfolio, and coming out as well. So leading into a recession, as you can see by this chart on credit spreads, you see that credit spreads start to widen during periods of economic stress. Now, what is a credit spread? A spread is really just the difference between two benchmark bonds. So as credit spreads go up, that means that investors are requiring more return for a given amount of risk. It's also representing that the credit quality of those bonds makes them more likely to have default risk, again, making investors require more return for a level of risk. So going into recession, you start to see it widen out. You start to realize there are uncertain financial headwinds. And what you're going to want to do is you're going to want to sell those below investment grade bonds, because those are the companies that are more likely to default, which means you may not get all, if any, of your investment back. And you may want to have a sort of flight to safety towards those more high quality bonds and those treasuries, because they're going to be less affected by those financial headwinds. Another thing you're going to want to do is you're going to want to keep your maturities short. So essentially, if things start to go poorly, those shorter dated bonds are going to be less likely to suffer because they're the more immediate term. It's more likely that the shorter dated bonds maturing next week, next month, next year, rather than 5 years from now, are going to be able to service, whereas those long-term bonds are more likely to kind of be affected by that stress and that fall in profits.
And
now coming out of
in this secular environment, obviously that's even more important, right? Keeping those maturities short.
Exactly. Now, coming out of a recession, you start to see credit risk is still increasing a little bit, but interest rates are starting to fall as the Fed would more likely be moving towards that quantitative easing. And as they fall, the risk of inflation starts to fade away. It makes more sense to increase the duration of those bonds you're investing in. Now, as you are going into the recession and the recession is hitting, you notice that there are those, like I said before, buying opportunities in bonds where those yields have gone up, right? Yields and prices being inversely related. So as it becomes evident and clear that you're starting to weather the storm, those bond prices having bottomed become a good opportunity for you to reinvest in. But generally speaking, the rule tends to be a flight to safety going in and taking more credit risk and getting that higher return coming out. Now, for decades, people tend to give you the 60-40 rule of how you should invest, right? And the reason behind that, is this next slide is kind of going to allude to how applicable that is going forward, is because bond and equity correlations for some period of time, for decades, were not that close, right? A correlation being a correlation of zero, meaning that two asset classes don't move similar at all, one meaning they move perfectly together, and -1 meaning they're moving opposite. But what we've found, and what is shown by this data, is that in periods of high inflation, those correlations actually increase, meaning that the reason, excuse me, the reason for taking that 60-40 allocation, which is to diversify and have a more smooth experience, doesn't stand as well in periods of high inflation. So the chart on the left is, yeah, you saw that last year. The chart on the left shows the correlation between stocks and bonds in both high inflation growth and low inflation, low growth periods. And you can tell the difference. In low inflation, low growth periods, you see negative correlation. In high inflation, high growth periods, you see positive correlation. And the chart on the right is just kind of plainly showing that high inflation equals more correlation. So because of this, if you really want to have a truly diversified portfolio, which means mixing asset classes that have differing correlations that are going to be affected by the market differently, you're going to want to invest in other types of investments. One of those could be real estate, which tends to have different correlations between equities because the drivers of expected return are different. Now, real estate you can invest in through direct property or through REITs on exchanges. Direct property tends to be less liquid. If you're buying office space, you have to find somebody who wants to buy it from you if you're trying to sell. If you need to sell it, you might have to take a haircut. But either way, especially when capital markets are in flux like they are and how they've been over the past year and a half, it can be difficult to get out of that property, which makes investing in REITs on exchanges kind of more beneficial to investors if they have liquidity needs. Now, these property values tend to be affected by both national and local trends, and different types of properties are affected differently. Industrial properties are going to be affected differently than storage REITs, than residential properties. In 2008, foreclosures were rampant and prices went down dramatically, offering what really was a generational opportunity to purchase real estate. I remember when I was younger, driving down the Pacific Coast Highway in California and seeing all this beachfront property with for sale signs and thinking to myself, man, if only I had the money to buy all this property. So recessions do offer an opportunity within real estate to get incredible discounts on highly valued property. Now, if you look at the chart on the top, what you see is during different recessionary periods, you really do have differences in how housing value is changed, right? So in 2008, which all of you remember, you see a sharp decline in prices. And that's because that recession was directly related to properties. In 2020, what do you see? You actually see flat price changes in terms of the change in the growth rate. And because people stopped spending their money on services and goods, they were able to spend it on property. You actually see right after the 2020 recession, property values skyrocketing. So this is really just to point out that different recessions and reasons for different recessions are going to affect property differently. And not just because you're going into a recession doesn't mean that real estate prices are going to collapse. It really matters the reasons why there is that economic stress. And that bottom chart is just showing.
I think that's that issue with going back to the PTSD side. It's everyone thinks that the housing market has to go to hell in a handbasket, and obviously the affordability is an issue, but modest declines like you saw even 1990, there were some real estate issues, and you saw roughly a 5% decline nationwide, nothing too dramatic. And so everyone thinks there has to be a 20% drop in home prices nationally, but the reality is, if there is one, it'll probably pretty minor.
Exactly. And the bottom chart is showing housing starts and building permits. And really the lesson here is that depending on why the recession is happening, depending on why there is an economic downturn, also changes the degree to which and the length of time which it takes for housing and construction to continue. So you see that in 2008, you had a massive drop off going into that recession, and it kind of flatlined for a little bit before building started picking up again. And that's because that deeply, deeply affected wealth across a vast majority of Americans. And we're still not to the point at which we were before that in 2005. So you see in 2020, you have that steep drop off because people are anticipating that consumers aren't going to be able to spend as much, but it recovers pretty quickly. So the recovery can be slow and the recovery can be fast, but it really depends on what are the factors affecting the economy. Why are we going through what we're going through?
And this also shows you why we do have a housing shortage. I talked earlier about that. Builders were reticent to build much, and you can see, look at the rate throughout the 2010s. We were pretty much building at rates below the entire 1990s because of that lack of willingness to build and get to and over stress their balance sheets, right, and get to a situation like they had in '08. Everyone was worried about that, and so you wonder why we're at a housing deficit now. That's exactly why.
Now, another asset class you might think of allocating towards are hedge funds. Now, hedge funds can be incredibly complex because there's so many different types of strategies. They can also have massive performance disparity. So in times of increased volatility, opportunities for gains in hedge funds increase, and that's because typically active managers tend to outperform passive managers in times of increased volatility. Remember, we're all trying to capture that upside volatility. However, they do tend to be less liquid, so it's difficult to get out of some types of investments within hedge funds, especially if a lot of people are trying to, which a lot of people tend to do in times of economic stress. There can also be some complex counterparty risk, meaning you don't necessarily know who's on the other side of the trade and if they have credit issues themselves. But this top chart really just illustrates kind of the excess returns of hedge funds over an index over different periods depending on where inflation is, right? So in periods of higher inflation, like we think we're moving into, you see that hedge funds tend to outperform far more dramatically. In periods of normal or below normal inflation, you see that the S&P 500 total return index outperformed. So there is some benefit to be gained by allocating to hedge funds within your portfolio in times of higher inflation, like we think we are in. But really the thing about hedge funds is that you have to pick the right manager. So this left chart is showing the performance dispersion over time from 2008 onward. You can see that in the early part and the latter part, the dispersion in returns tend to be wider, so not everybody does well. Again, in periods of high volatility, a rising tide does raise all boats, but if the tide's different managers are going to be raised at different levels. So it's really important to be able to select those type of managers, which can be very difficult, very complex, and very costly, given that hedge fund management fees tend to be incredibly expensive. And picking those managers, as the right chart shows, is important because they tend to exhibit performance persistence. So if you look at two different strategies, distressed investments, that fourth one from the top, and you look at event driven, you can see that especially in times where there's economic stress, where distressed investments don't necessarily do well, maybe where businesses tend to not be involved in mergers and things that event-driven funds take advantage of. It's important to have those managers who are good in multiple periods because their persistence of high performance gives you more of a possibility of a positive outcome, right? But like I mentioned before, this is an incredibly expensive mistake to make. A lot of hedge funds charge 2 and 20, meaning 2% of the assets you have with them and 20% of profits. So hedge funds can be a good way to diversify your portfolio, but picking the wrong manager can be a real easy way to lose a lot of your capital.
And I think it just shows you too the different types of hedge funds out there. Everyone thinks of hedge funds and they kind of bucket them all into one type of investment, but in reality is there are what you have here nearly 20 different, about 15 different strategies, and they all have wide ranges of outcomes and averages.
Exactly. Another asset class that you might want to consider is commodities. So different commodities perform differently In recessions, energy may gain or lose depending on the effects of supply or demand. Precious metals tend to be safe haven assets and hedges against inflation, but silver specifically is used in industrial production, so that price can fall. Copper historically has been a harbinger for industrial output, but today, as we discussed on the show a couple weeks ago, I believe, the price is seemingly tied more and more to the green revolution and the demand going forward. So if you look at this chart, what you're seeing is different spot prices of different commodities. So you see from the purple line representing gold, blue representing copper, orange representing oil, and green representing soybeans. So really what I want your takeaway to be from this is that although the general trend and pattern tends to be the same, you see the lines follow a similar track. What you do see is the magnitude and degree of differences are different. So investing in any commodity doesn't mean you're going to have good exposure to the commodities that are going to do well in times of economic stress. Again, alluding to the diversification benefit that not just varying asset classes, but varying commodities can provide for your portfolio.
And obviously gold definitely holds up the best of the major commodities in a recession.
So overall, there's some lessons that you can take regardless of how you decide to allocate across various asset classes. One of them is dollar cost averaging. So dollar cost averaging is saying if you make investments, if you allocate money, if you put money into the market over periods of time, you're essentially smoothing the average price over which you're buying. So dollar cost averaging and investing consistently regardless of market conditions can improve your investment experience. Another thing to do is avoid panic selling. If you look at that top chart, you look at how the S&P 500 performs during recessions from 1950 to 1922. So on the y-axis, you're seeing annualized return, and on the bottom, you're seeing the number of days from the start of the recession. Most people, like we say, remember 2008, and that's what they think when their mind hears that R word, right? But what this chart is really showing you is that not all recessions are like that. There's a wide disparity in terms of degree of market stress, degree of negative return, and length of a recession. Most recessions are actually focused more towards the center of that chart, right? So it's important not to panic because recessions are temporary. We've been through them before. We will go through them again. This is just a natural part of the business cycle. So maintaining investment in the market, given that it's difficult to figure out when we're going into or coming out of a recession, will give you the best and highest chance of having a positive investment experience. It's also important to keep cash reserves because, like I mentioned before, think about that property example. If you had liquid cash when real estate was really cheap, you would be able to get it at great discounts. So without that liquid cash, it's very difficult to capitalize on some of the opportunities that recessions bring. Another one is to rebalance your portfolio, right? Because things are constantly changing, the market is dynamic. So you can't just say, I'm going to set this allocation here and I'm going to keep it, because the factors that made you make that decision on day one are going to be completely different from the factors that are going to make you make your allocation decision on day 100. Justin, you're going to say something?
Well, I was going to say I love this top right chart, and that's going back to avoid panic selling. And it's just showing you the different S&P 500 performances, basically equity performances based on different recessions. And a lot of people just focus on '08, and they say, oh, the market drawdown 50%, but that's because you had this huge major deflationary impulse. But in reality, if you go back to the recessions in the 1953, 60, 1980, 1990, the drawdowns in equities were relatively minor. A lot of them had max 10, 12% equity drawdowns. Guess what? We just had a 10% equity drawdown. So, to say that, oh, if you go into recession, the economy, the equity markets have to crater, they don't. They could chop sideways. And especially in an inflationary environment, I think that's probably more likely than a major, 30, 40, 50% drop.
Yeah, and I think coupled with that bottom chart, the bottom chart's showing volatility through various recessions, right? So as that spikes up, that means you're going to see more whipsaws in prices. And so people experience volatility, right? That's what you're experiencing day to day. That's what you're trying to capture on the upside. That's what you're trading against is volatility. And especially in 2008, which is that big spike in that wider recessionary period, people thought the floor was going to go out from under them. But when you couple that with looking at the top chart and you notice that that line in 2008 doesn't keep going, it means it ends. So it's incredibly important to maintain a long-term focus and stay patient, and not everyone can. some people do have to start drawing down on their retirement. But one important thing that I remember is that in the spring of 2009, if you weren't invested for just the spring of 2009, you missed 60% of the recovery from 2008. You don't know when it's going to happen. The thing that gives you the best chance of capturing it is maintaining, an allocation to the market and constantly talking to financial professionals to try and get their expert advice. It's what they do on a daily basis. It's what we do on a daily basis, and rebalancing your portfolio and remembering this is a long-term investment. And Justin, you're talking about some key. Yeah, go for it.
Another thing about that chart that's interesting. I love that chart on the top right because it's so informative. It's not just the lack of major drawdowns in a lot of recessions, but it's the fact that by the end of the recession, right, saying you're still in a recession, equity prices were higher, right? 1953, 1960, 1980, 1990, 1981, even 2001, you were basically flat throughout the recession on the S&P. Obviously, the NASDAQ was down a lot. But, you could be in a recession and not have a ton of equity market volatility, especially in times when inflation is, still relatively positive, which we expect it to continue to be.
Yeah.
So here are my key takeaways. Fiscal deficits are here to stay, but consumers have healthy balance sheets and there's strong construction activity that's likely to continue to keep the economy relatively robust. Now, like I said, I still expect a recession, but a very mild one because of that fiscal dominance and the fact that the housing market, at least on the construction side, both from manufacturing construction to individual home construction, is likely to stay relatively strong. Inflation will continue to normalize, will continue to come down, but typically at higher levels than we're used to. So 3 to 4% is what we're expecting longer term. And you're gonna have volatility. So you're gonna see that inflation peak back up to 5, 6, 7%, and then come back down, based on certain shocks. If you have if Iran closes the Straits of Hormuz and you have energy prices skyrocket, that could be a catalyst, right? So expect interest rates to remain elevated due to that higher inflation. So keep your bond duration shorter. So a 64-40 portfolio can work, but you have to not buy long-term treasuries. Instead, you buy short-term, maybe corporates, right? So it's better to take actually credit risk than duration risk. Everyone's focused on a major credit default cycle because that's what they were afraid of in 08, and that's what happened in 08. But in reality, it's the duration risk that is the major issue. So on the equity side, you want to avoid exposure to companies that have major balance sheet issues and invest in resilient businesses. There should be a recession next year, but it does not guarantee the market will have a major drawdown. Don't think that this is a guarantee. And there's going to be opportunities either way. Okay, so focus on hard assets, low duration, and the 60-40 portfolio less effective, but it can still work with adjustments. So that about does it. That's a pretty good overview there. I want to highlight before we go, if you want to do a portfolio review, you can set one up with me by going over to InvestTalk.com. Just click on the portfolio review button on the top right. This is the report that we create by looking at client portfolios, right? What is the sector exposure, asset allocation? Are you leaning on the value or growth side of the market? Are you in long or short duration bonds? Looking at the portfolio weights and breakdowns, where you're overweight and underweight, and where you should be, et cetera. We also have various strategies that we deploy for our clients. So if you want to discuss that, we can certainly work on that. But this is how you get in contact with us if you have any questions at all. Obviously, our website there, our office number, and then that's our address here in Irvine, California. With that, I know we're over time by a lot, I think. But maybe do we want to take questions, or are we too over? What do you think?
Yeah, we can take a couple questions if anyone has.
A couple questions. So if you have any questions, here asks, why is gold not working? Well, actually, gold is starting to work. Let me actually pull this over. I'm going to get this chart. Pull my charts over. There we go. So let's look at this gold to the S&P. This is a ratio. So what you can see here is this surged in late October and has pulled back, but now it's in an uptrend. And you're seeing today as well, gold certainly outperformed. So while it hadn't for most of the year, and I think that's a lot of the fact that the economy stayed stronger than had been expected, and the Fed rate pausing cycle was pushed off a bit, you're starting to see gold outperform, which is not surprising. Anything else? So is ESG dead? No, I don't think ESG is dead, but I do think it needs a kind of a revamp to have it refocus on a particular to become more effective. Let's just say that.
Nothing is ever dead in finance if people desire it. It's just about making the changes to make it actually work.
Yep. Joe says, when you say to avoid long duration bonds, does that include bond ETFs like TLT and ACK? Yes, exactly. So
that's exactly what
TLT. It means. That's exactly what it means, right? So
before you show you, while he's showing you the chart, TLT has led to the most historic destruction of wealth, and nobody's talking about it. I mean, look at that price fall over the past 2 years.
Yeah, it peaked out around 180, and now we're at 87. This is supposed to be a safe asset, right? You're talking about treasury bonds, but this has fallen over 50% in the span of was that 3 years? 2 years? 1, 2, yeah, 3 years. So less than 3 years. So yeah, this is the change in a long-term trend. I always like to pull up this chart. I'll zoom out. And this is the 10-year treasury rate. And this peaked out back in the early 80s at around 15, nearly 16%. And it's been in a long downtrend. And now you've seen that breakout in yield. So this downtrend is broken. You're in an uptrend. Could you get pullbacks in rates? Absolutely. But, and it's not going to look like this in inverse, right? It's not going to just grind higher all the way to 16%. This next cycle in interest rates is likely to last a few decades, like it typically does. Typically, you get a 30 years up, 30 years down on interest rates, roughly. And we just started at 30 years up. But it may peak out at 9%, right? It doesn't have to peak out all the way at 18 or 16. It still could just be kind of a grind higher, but the general trend is likely to be up. So you want to keep those durations short. I know AG, which is aggregate bond index, that one, let's see, what's that down from call it 18 all the way down to 94 now. So very similar, obviously, about a 50% decline, and obviously you're getting a lot of duration there with AG. So yeah, you definitely don't want those.
Yeah, I think it's important to note that when people think of treasury bonds, they hear risk-free, risk-free, risk-free. That means credit risk. That means the risk of the U.S. government defaulting is zero, but you still take on duration risk.
Exactly. If you're taking duration, right? You can buy very short-term treasuries, 3-month treasury, for example, and that's pretty much no duration risk. So that's where you'd much rather be in a 3-month treasury than a 30-year treasury. All right. Andre says, when would you think debt monetization will happen, and what assets will benefit or lose most? Well, obviously harder assets will benefit. A big factor will be the dollar. If the dollar does roll over, it has kind of paused, and we're going to see where that next move is in the dollar. But obviously, a debt monetization means that there is an inflation, that's continuation of an inflationary environment. And actually, equities tend to do well. Certain sectors, there are typically 5 sectors that do well in an inflationary environment within the markets, and that is energy and basic materials. So commodities, kind of tier 1. Then you have industrials and financial services. That's kind of industrials right now, I think, much better than financial services, because I think banks are struggling while insurance companies tend to do well. And then there's real estate. So real estate does tend to do well, but different subsectors I think are going to thrive and others suffer. Obviously, office is going to struggle more than, say, industrial REITs, for example. Daniel says, I was looking at individual names. I don't want to get into individual names. Tom says, well, how correlated are international recessions, global recessions? They're pretty correlated, right? Especially in a world of globalization that while it's retrenching, it's still, there's still interconnected economies. And therefore, I do think if we go into recession, that will affect the globe. because we are we have the largest economy. Germany has been in a recession for a while. They're the third largest economy, and that's mainly affected most of Europe and definitely China because they're the biggest trading partner. So it's definitely interconnected in some way.
But it's important to distinguish the difference between direction and magnitude, right? So just because there's an economic downturn globally doesn't mean all countries are going to suffer the same. So you saw that in the wake of the Ukraine war. You saw with the energy crisis in Europe. Europe's issues with inflation were far worse than ours, and our recovery was far stronger. So just keep in mind that yes, they're correlated, but it doesn't necessarily mean the experience is going to be the same.
Exactly. All right, well, we're 15 minutes over, so I think we're going to cut it there. I appreciate you all tuning in, and we'll catch you next time on Invest Talk and hopefully our next wealth webinar. Thank you all. Have a great night.